Good afternoon, ladies and gentlemen. I constantly reiterate that I cannot be your financial advisor because there's so many things that come into play with your circumstance, how much money you're making, how much can you save, your age, your risk tolerance, all that time horizon stuff comes into play. And though I look at my portfolio as something that's set up that's comfortable for me, because even though Facebook is down pretty massively, we'll have this conversation 5 or 10 years from now and things will likely have changed. But unfortunately, a lot of people that I'm dealing with right now do not have that luxury of time. I've been talking to people moving into retirement, including my parents, and the topic of how to get a decent, reliable yield without losing out on capital growth is the discussion in play here. And it is a very challenging discussion in these markets. I've been using stock screeners. I have been going up and down different companies, looking at everything from those option covered call ETFs, which I found a few we're going to discuss, to a ton of different financial stocks, real estate investment trusts. But I've noticed because a lot of the consumer discretionary, a lot of these staples have really been holding up pretty comfortably in this market, making it harder and harder to find those higher yields without having to wait for the yield to compound over time and the dividends to get increased. So I pass this question off to you. I'm going to read through a couple of the stocks that I'm looking at and how I'm trying to build almost kind of a retirement portfolio, I'm going to say. And I've been getting a lot of input. I'm open to this discussion because, like I said, I'm not the end all be all of knowledge here. So I've been calling up friends, people from our chat group that I know are more toward that side of life, that aren't nearly looking for the growth potential as they are the sustainability and the cash flow to cover their bills. So somebody already mentioned in here, First National, and FN was one that wasn't on my list, which I noticed is paying a 5% yield that I'm gonna have to look into. And I want you guys to throw these in because I'm gonna pull them up and I'm literally just going to be adding them to a list at which I'm gonna be refining this list down based on my own due diligence and where I think the stability and safety is. Because option ETFs right now, I know are like one of the most attractive features because these covered call option ETFs can yield anywhere from 11 to 15+% sometimes. But the problem is in unstable markets, you end up running into a period where they can't sustain the cash flow, but they could still be a huge proponent of your portfolio. And I've been looking at a few even still that are big ones in our investing chat groups. I know I've got XYLD on here, RYLD. Those pay between 8 and 11% and have actually been holding up pretty comfortably in this market, which is nice to see. Enbridge is an amazing one. I've added, and I haven't added it to the list, but Enbridge comes up in conversation all the time because even at the position at the rallying, because I mean, it's pushing back toward its highs, but I mean, it's still paying something like a 6% yield. They've got great fundamentals, a renewable aspect of their business, and they're just a foundational stock for like natural gas and some pipeline options too, right? So ZWC, what is that one? ZWC, CWC. Let me take a quick look here. So that is BMO, Canadian High Dividend Yield Covered Call ETF. We got another one here. I'm going to pull this up. I wish I could share with you guys because this one's also very stable and is actually fully recovered from the pandemic lows. And it doesn't look like the markets are messing around with it here. Let me pull this because this is the Canadian side of the border. I love the Canadian stocks. It's primarily where the positions come from. So this is paying a 6.13% yield, which isn't bad. It's definitely on the lower end of the higher payers, but we're not looking for much more than over 4%. And when we get into the covered call option ETFs, they could definitely be a great proponent. That's an awesome mention, by the way. Thanks for that. Just based off looking at the stock price and just taking a look at the yield here, it seems like it's doing very, very well. So let me add that one to the list to go through. And what I'll do for you guys is I'm going to come back around and end up making a video breaking down, like I said, some of these suggestions that you guys are offering. And oh my God, there's going to be a ton of things. So GWO and BIP. So I think BIP is the Brookfield one, isn't it? But I'm going to add that to the list of stocks. So we got BIP. What else we got here from you guys? We got BIP, we've got GWO, MFC. Manulife's a great one. Let me add that as well. GIC, Manulife was already on the list. Some good financial stabilizers. The whole goal here, and the biggest challenge I think within this market when we're talking about the risk tolerance side of things, is people keep forgetting sometimes that their home is not really what I'm going to call an investment, because technically if you lose your job, you can't pay the bills, you lose your home. But the fact of the matter is if you outright own your house, especially anywhere in Canada, Ontario, that house is probably worth over $1 million. So some of the fear that comes into play with building out a retirement portfolio is you have to recognize that property is probably your largest investment. So you have to be relatively careful because you might want to buy more into some, say, REITs, or, maybe you want to leverage into private mortgages, but you have to kind of keep in mind that, you really kind of betting everything on the Canadian housing market, which is something that I kind of reiterate to people moving into retirement. So we're looking at things obviously like TELUS, some of the telecom sectors, which are very nice, high yielding here in Canada. The banks, I wish weren't so high right now because the banks are like no longer. You remember in 2020, were you guys around for that? I mean, I sold Apple stock to buy bank stocks, and they were yielding anywhere from 6 to 8%. They didn't cut those dividends, and they just started increasing them again. And I'm just like, man, oh man, like, can we go back to those days, please? I'm like, I remember having a good conversation with my buddy, and I'm like, and he was kind of getting into dividends and stuff like that. I'm like, man, you have to recognize that these yields never exist, right? Like they're unheard of. And he jokes about it with me now because he's just like, damn, he's like, man, I wish I took more advantage of that, but I'm not complaining because at least I was buying them when they dropped. Please cover OUSI. Yeah, let's add that to the list as well. OUSI. Like I said, just keep sending them over, guys. I'm going to just compile this whole list together, and I'm going to do a full breakdown of the ones that I think are pertainably the best. BIP for life. Thanks, C North. I definitely appreciate that. Added USI to the list. I still got to add SLF. So we'll put that one on the list here, SLF. Personally, like I said, I really like the Canadian real estate sector still, though. I mean, I really like what RioCan's doing here. It seems to continue to go up day after day after those earnings. So, I mean, I like it, but I want them yields, man. Even with the dividend increase on RioCan, you're only getting a 4% right now. So I've kind of shifted a little bit into Smart Centers. Now, I listened to Smart Centers earnings call. I kind of went through their financials, and the only thing that I always get a little uncomfortable with is the super high payout ratio, because I think right now Smart Centers is damn near tapping a 90% payout ratio. But REITs are designed to pay out more of their income. But yeah, I have NWH. Thanks for bringing that up. Northwest Health Properties is another really intriguing one that I'm going to touch on because it pays a high yield. Its payout ratio, I think, is under 50%, which is way more comforting. But the problem with NWH, as much as I like it, if you buy it in Canada, I think you're exposed to foreign income tax on it. You kind of got to be careful because if you want to get the dividend benefit, something to think about in retirement, or if you're Canadian buying Canadian dividend stocks, is that so long as that company operates 50% of their cash flows and it's coming out of the Canadian economy, you actually get a discount on the taxes paid, and even a regular brokerage account. But if you're buying something like NWH or even what's the other one that I used to buy? Granite Real Estate Investment Trust. It looks like they're Canadian-based companies, but when you look into the actual books, you start realizing that the vast majority of their operations are either outside of Canada, the U.S., or globally. And I don't know if the companies specifically deal with the tax internally, and then they just pay you out the percentage. Something to just pay attention to when because I just know you're going to lose the Canadian tax benefit. So it's better to hold some of those foreign companies or those companies that have foreign exposure within a tax-free savings account. Because that's kind of why I hold my highest yielding US dividend stocks in my TFSA, because I know I'm going to get dinged with a 15% over the border tax. But if that's all the tax you have to pay, you're not in the worst spot, right? Because it gets kind of annoying when you look at something like, say, Medical Properties Trust yielding almost 6% right now after it sold off after earnings. If you bought into that and you're holding it in a regular brokerage account, you're going to pay full income tax on it. So if your bracket's like 30%, if your bracket's 20 or 30%, then tap on a 15% withholding, you're losing like 40% of that income. So it's absolutely abysmal. So the tax side of this is very important to pay attention to. VDY is so concentrated to the banks and energy. That's fine. I don't mind if things are concentrated, because in the idea of building a diversified portfolio, obviously we could build out a bank in utility sector and then kind of find some of these other stocks you guys are recommending to pivot. What is that pull up on ISPO? 4 billion market cap, up 540% today. ISPO. I think somebody actually brought this up in our chat group, and I didn't have time to look at it because I've been too busy dealing with interviews. What the hell's going on here? So this is NASDAQ company here. So it's US, and it's called Inspirato Inc. What is going on here? This thing just bumped up massively today. Let's read here. Inspirato Inc. Rockets and morning trading. Financial service stock on move Thursday. What happened here? Is this thing even a dividend stock, or are you guys just shouting it out? Shares of the travel service company were halted several times Thursday morning, last changing hands at $51 a share. So why is it up? 350% late morning trading just 3 days after the company went public through a merger with, so we have a SPAC merger going on here. That's what's going on. Okay, that explains it. Sorry, is there a Canadian counterpart to VYM? there are a lot of Canadian high yielding dividend stocks. I think somebody actually mentioned one in here. You can get the cover call ones. You can just get the basic ones. Personally, I really like VYM. A lot of the companies in there, I think, are trading at highs, but when I look at those top weighted companies, like they make me drool. The ETF isn't overweighted, kind of similar to the Schwab, the SH. What's the ticker for that? The Schwab, dividend ETF. It's very similar to VYM. I don't like Schwab as much personally. I know it yields higher. It's had a little bit better performance, but I think that's kind of related to its concentration. Its top weighted holdings make up, I think, like 40% of the fund, whereas VYM is much more diversified. And honestly, guys, I say this a lot. When you're looking for companies as a new investor, just go straight to those ETFs and look at the top holdings, because those are primarily the fundamental companies that are the best companies in the world, because these ETFs have already done their homework and they're already buying the best ones. And at the top of the list on VYM is Johnson and John, or not Johnson and Johnson, JP Morgan. So it has heavy bank weightings. A lot of those like consumer discretions or the staples, like obviously Pepsi, Coca-Cola. You're getting your healthcare in there, like your Pfizer's. So lots of great companies out of that. I noticed that, hey, Kyle, I'm sure your philosophy is to always average into the market. But if you started investing in 2021 and witnessed this correction crash, would you be investing in the S&P 500 or careful with cash? So if you're starting from scratch, it really comes down to, and I think this is the best way to think about it, how much money are you going to make in a year after your taxes, expenses, that you can invest on top of what you already have ready to invest. The reason I want you to framework it that way is because let's say you have $10,000 to invest, but you're able to retain like $15,000 or $20,000 of your income every year. And you're kind of like one of those people that wants to put away 30 or 40% of your income to fast track your retirement. I wouldn't be worried at all about just dumping it all in the market at once, because you're going to make a much higher return just by saving money. And you're going to be filling that account up so much faster than the value that money's going to create. Even if it went down or dropped 20%, it won't even be a blimp on the radar. Like that's a lot of thing that people argue about, because sometimes when you look at people's rate of returns, sometimes they're just showing along with the capital they add to it. It's actually a problem with my Bitcoin wallet, because my Bitcoin wallet shows my returns plus my capital contributions, which is really annoying, because it really looks like that my Bitcoin rate of return is really stabilized, but really because I consistently add to it. And even when it drops, it makes it look a little more level than it is. But honestly, yeah, if you have like 100,000 to invest, and you can only put away 10 or 20,000 a year, I'd take a breath. And I'd be more focused on cost averaging, being a little bit more careful with cash and trying to pick up the dip opportunities. But it really just comes down to the percentages of like what you can make and what you can save and what you can invest. So honestly, if that's your position, I would just dump it all in the market now and then just cost average all the way through the rest of the year. Just personal preference, because I don't like being on the sidelines. If you guys watched Warren Buffett or Charlie Munger at the, he just did the meeting with the Daily Journal that he's one of the board members of. And I mean, he touches base on stuff that I wish more investors would highlight. I joked in my video today because I noticed Meet Kevin talked about it. And the guy just pulled out all of the information about how bearish Charlie Munger is on the market, just to kind of solidify his statements of, I think the market's going to crash. But if you watch the whole thing, he says, I'm not predicting the tides. He's investing in this market either way, right? Way too base lately. Yeah, he's very interesting to listen to, though. I love his take on things. The guy's still an icon. I love how short and simple his answers are. Thoughts on Shopify? Shopify crushed everybody right now, man. It followed suit with Facebook, and I think Facebook sold off because Shopify sold off. I honestly have it on my buy list, but the problem I have is if I had to pick Shopify or Facebook, I still would rather buy Facebook any day of the week, just because Facebook's got by far the best balance sheet of almost any company still that sits on the top 10 when we're talking about a cash machine. And, they both have the same risks. I mean, Shopify and Facebook sit in the exact same realm of like the economics of just online platforms. So, I'd still rather buy Facebook at this 15 PE that it currently has, which is insane, because it's not like, the revenue slows down a bit for a year. Whoop-de-doo. I mean, they're still going to take in more money than, Shopify is probably going to see for the next 5 years. I have both. Facebook definitely over Shop. Yeah, if Shopify drops, though, I have it on my buy list. I might consider adding it if the PE ratios get a little bit lower, and we just see how the first quarter or two goes. And honestly, I still have Baba on my list. I have a lot of growth companies on my buy list. And, I think it's funny because some guys just want to cost average into them. And you could call me a little bit more speculative and a little bit more gambly, but to be honest, guys, I like buying the rallies. I don't like catching the falling knife like Jeremy does. I don't know, you could call it foolish, but honestly, I could sit here for the next 2 years and watch BABA flatline, but if BABA jumped 50% tomorrow, I know the political rhetoric is dying down. If that continues to die down and change, I don't mind paying a 50% bump and seeing BABA at 200 and me start buying back in at that price. I would just rather know that the tensions have eased to take away some of that risk. And same with Shopify, Facebook. Like, a lot of people love those companies. Great to start a position here, but I would just be patient until we find bottoms and the market finally levels off, because it's not fun, man. There's nothing fun about buying a growth stock and just watching it continually downtrend. And remember, I say this all the time: nobody knows how low stocks will go. I know a lot of people think things bottom, but you just don't know. So like I said, man, that's why dividends are always a wonderful proponent of the portfolio. So bringing that back up for newer investors in here, we're looking for dividend stocks for retirees, because retirees don't have time horizons as long as I do to sit here and watch Facebook recover for the next 5 years, or Alibaba. So what we need is cash flow. And honestly, we're trying to look for something reasonable, a nice little balance. Google or Tesla are not going to offer me cash flow here. I'm scared of those tech companies. I've got a prediction here, guys, and this is why I actually sold off Tesla. Not all of it, obviously. I just scaled them down. I even sold Apple, Microsoft down, because I think we're going to see a domino effect. You know, I think it's crazy to me that Tesla is worth more than Facebook is right now by hundreds of billions. I mean, when you look at what Facebook produces over, say, Tesla, that bottom line, it is night and bloody day. I don't know how Tesla can trade up here, to be honest. Like I said, I still hold it. I still love it for the next 10, 20 years. Think it's a great company. It's just a matter of the dominoes are falling. It's just one large cap after another. Apple didn't post guidance. Google didn't post guidance, and I just can't foresee them, when everyone has lowered guidance, that they're going to have some kind of blowout quarter in Q1. Q1 is always the worst quarter. So let's see how bad it comes in with Apple, Microsoft, Google, Tesla. And I think Tesla's numbers are going to be fine. It's just a matter of, if all the large caps start selling off, it doesn't matter how good your numbers are going to be. You're just going to see Tesla sell off with it. It's kind of the Cathie Wood effect, in my opinion. Like, a lot of people are just battering Cathie Wood, but they don't realize that the domino effect takes place when people start selling out of those ETFs. Because if people get fearful of the market and they start selling more S&P 500, if they start selling, like, even Cathie Wood stock as an example, the ARK ETF, those companies don't have a choice but to sell out of the underlying asset, because that's what you're buying into. You give the ETF money, they in turn give you new shares. So new shares are issued from the company to you. They take that money and then it gets diversed into all those stocks. So the problem is when you sell back those shares to the company, they now have to liquidate the stock, and it leads to that domino effect of these continual sell-offs. And I think that's one of the reasons that Cathie Wood stocks have gotten hit so hard, right? Because so many people went risk off in the ETFs, and that caused hundreds of billions of outflow. And on top of that, the individual holders were also selling, which I think leads into some good discount buying opportunities. But like I said, I'd rather see a 50% bump and just watch a crazy rally happen and buy into that, and just know that the dark times would hopefully be behind us without a black swan event knocking us upside the head. ETFs are traded between buyers and sellers, not the ETF provider. It depends on the ETF, because I know for a fact, and I'm pretty sure I could look it up right now, actually. VOO, I'm 90% sure when you buy into VOO, they issue you new shares. I don't know how much is traded. You might be right. I could be wrong. But from my understanding, ETFs, let's say no one's selling an ETF and you buy into it, they issue you new shares. It's kind of like the difference between that and closed-end funds. Like, closed-end funds, you're trading the shares. You're not actually buying the underlying assets. ETFs are really confusing. If you guys don't know closed-end funds, they're very intriguing because they're disconnected from the underlying assets they invest in, and you're kind of trading it outside of the assets. So sometimes the stock can be trading above what it's paid for those assets, and sometimes it trades under. It's very, very confusing stuff. It's very confusing stuff. That's why I like sticking to the simple guys, your VOOs, your VMYs, things where you don't have to learn too much, because like I said, when you're investing in individual stocks, things become very complicated very fast. So I'm going to throw this out here one more time. I need a list of dividend stocks, guy. High yielding dividend stocks. The ones on my list right now in the REIT sector: RioCan, Smart Centers. On the US side, Medical Properties Trust is great. These are all yielding anywhere from 4 to 6%. Northwest Medical Properties, Allied Properties Trust is great. Small caps, you got things like TNT.UN, the Toronto, I think North something. It's kind of an office REIT that did very well through the pandemic. Stock side, with some of those high yielding ETFs, whether we're talking covered call ETFs like XYLD, RYLD, VYM is a good one that's not covered calls, way lower dividend yield. ZWC was one that you guys mentioned on the Canadian side of the border, yielding 6%. That's the BMO Canadian kind of covered call ETF on some of the higher yielding dividend stocks. I think I'm going to have to double check that one. Stocks on the Canadian side of the border. I mean, I still love the banks. CM, BNS are probably the best ones for yield. FN was one that one of you guys mentioned. I think that was a US stock, not sure. Enbridge for sure, BIP, GIC, MFC, OUSI, SLF. What else do we got, guys? I need some. HYLD, HVID. Thank you. Let me add those to the list. So we got HYLD. HYLD. Like I said, I'm going to be going through these pretty aggressively over the coming months. HVID. Like I said, man, my time horizon, I don't care if my portfolio drops 30% tomorrow. It's not the end of the world. But if you're sitting on retirement right now and you're looking at no longer contributing to your accounts, things are a whole different ball game on the macro aspect of things. So we're looking for those really, really good, safe, well, not even safe, just relatively high yielding stocks that come with some security, because you're just going to diversify it to kind of mitigate the risk. And the idea is you want some of those really high yielding stocks to balance out the lower yielding ones. So you get VYM at 3%, but you're getting, a REIT at 6%. That's going to balance you in the middle there around 4%. The end game is to try and get a 4% comfortably without giving up all of your upside, because ideally on the years where the market does well, you're going to make a lot more than your average dividend yield, and you can always sell out of VOO and scale it down as it rallies up, because I don't know why people can't think they can do that. For some reason, people just they fixate too much on dividends and forget that if the S&P 500 goes up 20% one year, you could still sell $10,000 worth of the gains, let's say, or 10% of the gains, and you're still up 10% overall, and you haven't really lost that much. VYM is a good core holding. That's one that I've been adding aggressively to lately. I really like it because the dividends increase on it, and they just own the most foundational companies. I like Costco. I've been looking into Costco and stuff because Charlie Munger said that he's not selling any of his shares. He'd have a hard time buying shares here, but he just doesn't think there's a more foundational company that has access to kind of the retail exposure. I love Costco, but man, how does things like Costco and Pepsi trade at those multiples? Like I think Costco's over 40 PE right now. Pepsi's in like the 30 range. Like how are these consumer discretions trading for higher multiples than something like a Facebook does? Like the cash flows are incomparable, right? It's kind of mind-boggling to me. BRD, a monthly payer too. Thank you for that, sir. I wish I had time to look these up right now, but I don't want to waste your guys' time. So I'm just trying to compile a list and then I'll go through them. BC, they are way overpriced. Yeah. Well, I mean, it's hard to say if they're overpriced though, right? Because it depends on your horizon. It's like me and Matt say, it's like if you're buying Tesla today, I mean, you're not buying it for today's price. You're buying it for 10 or 20 years from now. And that's what Charlie Munger said about Costco. He's like, if you're buying it for the next 30 years, he's like, I don't know how you can't buy it here. Obviously, we all want to buy it cheaper, but it's USOI. Sorry. Thank you for that. I'll do the correction. USOI. Keep sending them over, guys. I'm just going to do this for a little quick bit. Sorry, it's probably not the most entertaining live stream, but I feel like this is how I'm really kind of getting my head wrapped around a new way of thinking from a different time horizon perspective. Thoughts on Intel? Yeah, actually, Intel's a good one I should add to my list. That's a good recommendation over I like Intel a little more than I like NVIDIA here. I would love to buy NVIDIA, but it needs to drop. I don't know how it's holding up as well as it is. I think it's been selling off a little bit the last few days, and I've got it on my buy list as well. But like, I mean, when I put a fair price on NVIDIA, God, it needs to drop down to like the 180 range, and we're still at higher premiums at that price. It's kind of the same thing with like Microsoft and Apple here. Like you kind of have to have a big stomach to be buying them at these prices right now. Please comment on smart centers and choice earnings. So I didn't look at choice properties. Let me pull that up real quick because I think they're also a pretty big dividend payer. Choice properties. What does that one pay? Yeah, so they're paying 5.11%, and they're doing pretty good overall. Personally, I'm a big fan of smart centers. I don't expect to get growth out of it. I'm just pulling up choice properties because I just want to see in comparison on their statistics because their payout ratio. Yeah, so their payout ratio is kind of similar to smart centers. Their financials any better? Yeah, their financials are okay. It looks like they've been downtrending a little bit similar to the smart centers. Yeah, they look very similar, actually. Fairly similar from just looking at the basic books right now. Honestly, like I said, I just talked about this. Smart centers is great. I have like I said, a hard time fully trusting it to enough degree that I put huge amounts of money in it. I still like Ryokan way more. I think Ryokan is the premium. You're just not getting as high of a yield. But when we're talking about security and longevity, I mean, their payout ratio is something like 70 to 75%. Their earnings were stellar. Smart Center's earnings were stellar. They're both doing great. I love them. They're diversifying their portfolios, getting into residential. Smart Centers is building out into retirement housing, and not that kind of retirement housing that requires like healthcare. Like they're just kind of building out those comfortable retirement housings that are like rental units for older people. So I kind of like their positioning and how they're going about it. So they're just crazy diversified ETFs. I love both of them. Love them both. Kyle, I made a mistake. It's actually USOI. I saw that. I fixed it on the sheet there. I wish I invested more in NXST, Next Star Media Group, especially with being a political year. So the media groups, a great dividend yield. Okay, I'll add that to the list. NXST. NXST. You know what's really intriguing when we're talking about the media side of things too? I know it's kind of segued a little bit. I really am intrigued by Activision here, man. I hope you guys are following the Activision Blizzard story because I think Berkshire Hathaway actually has a position in it. And it's still trading below the sale value. I don't see for whatever reason that this deal isn't going to go through. And from my understanding, I think the sale price is at 85 or $90 a share. So if you buy Activision Blizzard right now and it buys out in the next year, you make an immediate return. I don't think it's as much as it was from the bottoms, but I'd have to double check. So what's $5 is what percent of, I think it's over 85. I'm just curious here. So yeah, like you're going to make a 6 to 10% return if you buy Activision today and that buyout deal happens. I mean, it's such an intriguing, it kind of reminds me of the SPAC deals. SPAC deals are interesting. I don't know how many of you guys went down the SPAC spectrum, but the thing with SPACs is if you buy into the before it merges, you actually are owning a unit value that isn't traded off a stock price per se. So if you see a SPAC and it's trading at its unit value of $10 and you buy it at $10, you can't lose much more than 5% because the only value that extends above what you paid for it is the warrants. And the warrants are already priced in. Usually it's about 5% of the total holdings and they're holding cash, right? So it's kind of confusing. But basically, if you find a SPAC that hasn't got a lot of attention yet and you kind of know what the deal is going to be about, if you can buy it at its unit price, your only downside risk is 5%. And if it catches steam before it merges, there's only going to be so much money they're going to raise, and then the stock price goes up, and you just make infinite return so long as you sell it before it merges with literally almost no downside risk. That's kind of a similar setup with Activision Blizzard right now. Presuming the deal goes through, you're guaranteed a minimum return. And I don't know. It intrigues the hell out of me. It intrigues the hell out of me. It's not often you see deals like that in the market where there's like limited downside risk, because honestly, if the deal doesn't go through, you're still getting a great company at a decent price. Like it's kind of wild. True. That's why so many SPACs get dumped and then pumped near toward the $10. Yeah. So, I mean, SPACs will literally only drop so low, and that's as low as they will ever go. It's very intriguing, very intriguing. But the problem too is you have to look at volume, because if there's not enough volume, you can't exit the position, and that would suck. And the best part too is, hey, the deal doesn't go through on a SPAC and you bought it at the unit price, you just get your money back minus the warrants. So you might lose 5% at most, like literally no downside risk. ETH, let me add these here. So we got ETHY or BTHY. Both are high yielding crypto ETFs paying monthly double digits. Yeah, man, I'd love to get a crypto exposure. Nothing wrong with that. ETHY. Let me add those to the list. ETHY. And what was the other one there, real quick? BTHY. BTHY. Yeah, man, I take all of these into consideration. And like I said, guys, I'll be making some videos on these, on the ones that I think are the most intriguing. Negative 80% return. Yeah, I'll have to look in the returns. Crypto dump today. Long-term believer in crypto, but what I don't trust is the APYs. I mean, we just saw BlockFi get, I think they got blocked, didn't they? They're not allowed to do any new leveraging, which is kind of scary. I had a hard time because there's something called Ledin.io. It's like the Canadian version of BlockFi. You can give them your crypto and they'll leverage it for you and they'll pay you a few percentage points. But I've noticed that the APYs have fallen off a cliff. And yeah, I didn't trust it in the first place. A lot of people made a lot of yield on it. But right now, man, I like my Shakepay. Free Bitcoin every day. Just log into the app, shake it. It's phenomenal. And then I can keep all my crypto without having to give somebody up my keys and give them control over the wallet. Anyways, guys, like I said, I don't want to waste too much time here. So we'll ask one more time. Any other stocks you guys are interested in? 3M is a great one that I added to the list as well. They've been tanking lately off that lawsuit news or whatever. And they're still a great company. IIPR, I'll add to the list. IIPR. What else do we got here, guys? CWB, CWB. Like, it's so hard finding these through a stock screener. Yeah, so we got those ones on the list. POW, I think I've heard of before. Let me add that to the list. High yielding dividend stocks. Kimberly Clark's another interesting one. I feel like that one's purely for yield. It's kind of like Unilever. I wouldn't really buy it expecting a stock return. I know Clorox is intriguing at these levels, but I don't know, man. If Clorox doesn't get their shit figured out in this logistics nightmare, they're going to cut their dividend. It's kind of scary when the dividend yields get over 100% payout. Yeah, Kimberly Clark and Unilever. Yeah, for me, I bought in and out of Unilever and Kimberly Clark a little while ago. Like I said, I'm so young, I want growth. I'm willing to give up a few percentage points of a dividend yield to get dividend yield growth. That's why I like things like Pfizer so much right now in the healthcare sector. I feel like the healthcare sector is really underrated at this point. It's been selling off, and their payout ratios are very low. Their dividend yields are very sustainable, and they're doing exceptionally well through the pandemic. I mean, I talked about this before. I know Pfizer's a pretty politically dominated topic on stock twits. I try not to get involved with that. I just look at the distribution and I just look at the company as a whole, and it is unbelievable. I mean, me and Matt joked about this on the live stream. I think more people have been touched by Pfizer than have been touched by Apple. 1 in 6 people in the last year have used some version of Pfizer's products or vaccines. Unbelievable. I mean, I don't even know like how you wrap your head around that distribution network. It kind of like it reminds me of looking at like an outside view of the internet connections globally and watching how the internet works globally in real time when you see all the connections happening. That's how I feel about Pfizer. I'm like, I don't know what their global network looks like. They don't really show you too much insight into that side of it, but my God, it has to be insane. It has to be insane. It's a marvel in and of itself. HYLD, brand new. Let me pull that one up here. HYLD. I think I've heard of that one before. I think somebody mentioned it here. Add that one to the list. So young, how young? I'm 29 years old, man. I'm obviously trying to fast track my retirement here. That's the whole point. The higher percentage of savings you can put away, the faster you can lower your chances of making it to retirement early. I mean, I've already got over 300,000 saved up, and I'm still being diligent, still going to try and put away about 20 to 30% of my income. So, I mean, like I'm looking at retiring by my 40s. Not that I'm going to retire. There's no need to retire, just financial freedom and just having the luxury of being comfortable. So I figure 10 years of dividend increases with the stocks that I hold. Plus, I'm going to continue to add insane amounts of capital to the portfolio over the next decade. I don't see me not having somewhere near $1 million at the minimum, I'd hope. United Health is another undervalued healthcare. So United Healthcare, let me add that one to the list. United Healthcare. Yeah, I love the healthcare sector, man. I don't feel like you can go wrong. Take a look at NTR. So is that United Healthcare? Is that the ticker for it? I'll just add it either way, just in case it's not. NTR. BNS, already got BNS on the list. Kyle going to retire with 10 Lambos at 35. See, I don't care about cars. This is a fun conversation. Look, I don't think you should give up luxuries in your life for an early retirement. Doing this financial independence thing, I don't think is for everybody. I just feel like the luxuries I enjoy in life, I think, are drastically different than most people. I could go out and afford a BMW tomorrow. If I wanted to buy a Mercedes, a nice car, I could. But I literally had this conversation with one of my good friends last night. We were just having a drink, and I was just like, who wants a nice car? Like, really, though? I mean, I go back to the example of when I used to drive a Dodge Charger for work. I only bought it for like 8,000 used, and somebody hit it and ran in a parking lot. Didn't care at all. Didn't bother me whatsoever. I could write off my car tomorrow. Wouldn't even come up as the slightest bit of concern in my life because it costs nothing. I think right now my car payments, I own my car, but my total car payments are like 2% of my yearly income, which is insane. I worked really hard to get it down to those levels. And I just don't like having to worry about shit. I don't want luxuries in my life because I hate worrying about them. I know a lot of people like those things. And if you like cars, if you're a car collector, if you're into that stuff, I mean, you don't have to do what I'm doing. I don't care for it. I get in a Lambo or a Tesla and I'm like, yeah, this is cool, but it's just another fucking thing that I got to worry about. I mean, I got to get up every day, pay more for insurance, worry about if somebody hits it. Like, you got to care so much, and it just becomes so much of your attention and time. Just why? I don't like it. So, I mean, it's weird because I can actually afford shit in my life. And so far, the only thing I've spent a lot of money on is this laptop and a desk. And going out for dinner. I mean, like, I like going out to restaurants once in a blue moon. I don't mind spending money on traveling. I mean, I was going to go to Vegas, that kind of fell through. But I mean, when it comes to like just regular shit, who cares, man? I don't get it. It's such an ego play for people. I'm like, my ego play is not having to worry about anything. Like, if I can get up in the morning and not care if someone just steals my car tomorrow, you know how freeing that is? Like, it doesn't get better than that. Paying for cosmetic damage is pointless, in my opinion. Same, I don't care. And I don't care what people think either, man. I kind of got past that age of caring what people think about, having fancy things in your life. It's the same thing with clothes, right? Like I get fancier clothes over fancier cars because you might be a little less worried and you get to wear it and enjoy it, whatever. But I'm not buying fancy clothes either, man. I shop at thrift stores. I mean, I go to Costco. Same thing as Charlie Munger does. I mean, he buys his clothes at Costco. I don't need to be a Louis Vuitton dude. I don't need to see a $2,000 price tag on a shirt. No thanks. It's just gonna get dirty and thrown in. Honestly, this is really bad. Where is it? I'm gonna show you guys something. This is really bad, by the way, but I actually have it sitting here. So this shirt, I joke about this shirt a lot. I don't wear it really anymore, but I have had this shirt. It's a Walmart dress shirt. I have had this since I have been 19 years old. This thing is over 10 years old and it never gets wrinkled. It still looks exactly the same from when I bought it. And it's like a $15 dress shirt. Honestly, blows my mind. I'm like, when I look at this thing, I'm like, why is this in my closet? It's the only shirt that I still hold. This is a newer shirt. Most of the clothes I have is newer, but this thing still comes up. And I'm like, what is it with Walmart having shit that lasts longer than the expensive clothes that I buy? Like the expensive clothes, you got to iron it. It's harder to wash. This thing is no wrinkle, throw in the wash, put on. It's all good. I think it's hilarious, to be honest. So, I mean, it's the same thing with dress pants, man. I have really expensive dress pants, but it drives me bonkers because they get wrinkled. You got to iron them. And the Walmart dress pants, you never iron them. They always have I'm so bad. I'm so cheap. I don't want to say cheap. Cheap is a bad word because I do spend money on friends, family, traveling, whatever, but I'm frugal. If it's just a luxury item or whatever, I'm frugal as it gets. Walmart is all I need, man. It doesn't get more complicated than that. H&M has amazing clothes. We're really going off topic here, aren't we, folks? I mean, it's great though. If it's good enough for Charlie Munger, hey, it's good enough for me. I don't get up in the morning and spend much more than 5 seconds thinking about what I'm grabbing out of the closet to wear. Yeah, I don't like the word cheap. I really don't like the word cheap. I hate when people use that word because sometimes I get that word thrown at me that I'm just cheap, but I'm not cheap, man. I feel like I would rather donate money to a good cause or a charity, and I have in the past. I don't talk about that shit because it's just pointless. Like I hate people that brag about the money they give away. So I mean, like I would rather just donate to my friends. I got friends that aren't doing well. I'll help them out if they ever need it. That makes me feel better than some Louis Vuitton shirt or whatever. I mean, that's where I feel more value in money. The real question is, are you wearing pants? Yes, I'm wearing my track pants. This is the work from home office lifestyle, my guys. I'm like Kevin O'Leary. Like sometimes I'm wearing shorts, sometimes I'm wearing just my nightwear or no pants at all. But at least it looks good on the top half, right? A minimalist Chad. Yes, minimalist Chad. It's a funny statement. That's awesome. Zoom attire. Man, I love the Zoom life. Honestly, I think my dreams have truly come true. Sometimes you got to reflect on what's happened in your life. And I remember years ago when I started this journey, I said, I want an unlocalized job. I want to be able to work from anywhere in the world. And I just want to have enough backup capital to just sustain with zero debt, no car debt, none of that shit, no student loans. And I would be comfortable. And I feel like I'm there. I'm like, I actually did it. I got a decent amount of cash flow. I got enough money saved for like 10 years of my expenses if I ever had to tap into it. And yeah, and I get to work anywhere I want in the world. And, I'm going to be moving soon. So I'll be going down to Toronto. And I forget that that's actually happened in my life because I remember that being a big goal that I was working hard toward. And I'm like, damn it, the world has given that to me. I can't complain. If you have a son, I want him to be savvy like Kyle. Oh, if you have a son. Yeah, kids are cute, man. I think when it comes to kids, I wouldn't worry too much about money with them. I'd like them to be smart with money. And I feel like if they're around people like you guys, they'll figure it out as time goes on. Because I've noticed that anybody that grows up with parents that have somewhat financial sense, they tend to do pretty well because the parents are like, we're going to pay for your student, going to school. We're going to pay all that off. We're going to support you. We're going to start saving money when you're a kid. They open up those child benefit accounts. I know a lot of people in our chat group have done that. But when it comes to kids, man, you don't want to worry about money. You don't have to have that stress. You just want them to grow up, have fun with them. You don't want to worry about that stuff. You just put a little account sides for them. And again, by the time those kids hit 20, even if you invest 5 or 10 grand for them, I mean, they're going to be so well off. I mean, they'll be richer than 50% of, or like more than 50% of Americans. If you just put $5,000 in an account the day they're born, just dump it in an index fund, never look at it again. You'll change their lives. Things have changed because if you went back when I was a kid, I don't even think that was a topic of conversation. I don't even think people knew there were like child benefit accounts, not like today. rs.to, thank you. We got some more dividend stocks. Keep sending them over, guys. Just looking for a list of dividend stocks as I'm trying to help people out into retirement and looking for cash flow and stability at best. So I'll add that to the list there. RTO keeps saying, children are the time millionaires. Yeah, it's such a shame, man, because I remember Bill Ackman made that point. He says, why do we do this helicopter money when if you wanted to guarantee every single citizen's retirement at an annual rate of return of like 7 to 8%, like average market returns, if you'd only have to invest, I think 16 or 1700 from the day they're born all the way to retirement age at 65, and they should be left with somewhere between 800,000 and $1 million, or 600,000 to $1 million bucks, depending on the market. I mean, that's all it would take. It's like people keep forgetting. I mean, 60 years it kind of reminds me of Apple stock, like, because Apple, I was one of the first stocks I bought several years ago. And like, I just can't get over the return that it's had. I mean, it's nuts. I'm up like 1,000% on it. It's just like, it doesn't take a lot. Even the markets, right? I mean, let's go back from when I was a kid. I was born in the 1990s. How much would I have in this market if I could go back? I can't even pull up a chart that long on the S&P right now. Let me pull up the SP 500 here. Let's take a look. Can we get a long chart on this? There we go. Okay, so from 1992, that's when I was born. The S&P 500 was worth $385. I'm now 29 years old, and get this, I would have had 1,000% return in just in under 30 years. Oh, that's unbelievable! Unbelievable, man. $1,000 would have went a long way. That turns what, $1,000 into 100 grand, baby. Doesn't take a lot if you've got time on your side. Rich Gang, baby, let's go. True. Yeah, I know it's kind of incredible to think about, right? And I mean, even still, when I think about, like, you guys are all young too, right? I mean, most of you guys are young. You keep forgetting that you have a long time horizon. But again, I just want to reiterate, enjoy things in your life because you might not make it to retirement. I think people forget that too sometimes. Like I said, I made this in my last stream when I talked about this. I'm getting hit with a lot of different angles. And it's kind of frustrating, and it's hard to kind of batter it around in your head because I've got a good friend of mine that unfortunately has stage 4 cancer. And he said, like, I was planning on, waking it to my 50s and 60s and then being able to travel, having the house paid off and living out, a retirement life. But now he's never going to get that, right? It's a very depressing conversation when now you have to talk about how they're going to set up their financials for their family, because unfortunately he's not going to be around in the next couple of years. And then same with my parents, right? Like, my parents are moving into retirement. They don't have any more growth time horizon. So you really have to be dependable on the money that they have. And then in my time horizon, I've got the next 30 years. So I can't invest the same way that you would be investing for my buddy that doesn't have a time horizon anymore. And with my parents, that their time horizon is also obviously cut down and they need to be able to rely on it. So, I mean, when you think from all these different angles, I mean, it really makes you reflect on your own investing style. Because I think this is why Dave Ramsey really recommends that you don't invest more than 15% of your income, because you have to enjoy life too. I mean, luckily I enjoy investing in stocks. I wake up every day. I love learning this stuff. I think it's great. But at the same time, like, most people might not enjoy that aspect of life. So don't make life miserable and thinking that, oh, I got to put 30% of my income away. It's like, look, if you got 30 or 40 years to invest, man, I mean, go buy a Mercedes, go buy a BMW if it makes you happy, so long as you can afford it. I mean, I got nothing against that stuff. I got nothing against nice clothes. It's just not my personal preference. Anyways, like, well, it feels bad. Depressing is serious. That's a great channel for monthly dividends info. Zach, isn't Zach the passive income investing channel? I was kind of annoyed because he used a very similar name as mine, and his channel comes up before mine when you search them on YouTube, which I think is kind of funny. I'm not sure if you come across his YouTube channel, but passive income investing. Sorry, I just saw that there, Zach. Bring us up, Kyle. Bring us up. I know I've been such a downer lately. I'm happy. No one's complaining here. We're all living a good life, man. If you're in this chat group, you're living a good life. because you figured out more than 50% more than 50% of Americans have before they've even come close to thinking about retirement. If you guys want to be lightened up, I do this for fun. Just go listen to Dave Ramsey. I mean, the only reason I watch his channel is because, like, when you listen to how screwed up people are, it's bad. It's a guilty pleasure, but there's nothing that'll make you feel better than a guy in his mid 30s that still has 100,000 in student loan debt and doesn't have a dime saved for retirement. I know I feel shitty for that guy, but it really puts into the reality, the situation you sit in. Do you have any real estate? No, and I don't plan on buying any yet. Canadian real estate is out of control. If I could afford a decent piece of real estate without going broke, I'd love to. Hey, Kyle, you ever think of collabing with any new channels? So what I'm planning on doing is I'm in a position right now where I work with so many companies. I don't try and, cross the channels too much because in my current day job, like I'm working with 30 or 40 publicly traded companies. Some of these are unbelievable. I'll be bringing some on this channel soon because I think their stories are very interesting and I'm kind of glad that I can pick and choose. So we're going to be kind of doing like some podcasting with them where I'm just going to have kind of broad view conversations. So it's not like spammy, necessarily just promotional stuff for their stock. I'm just going to bring them on, have a broad view conversation about the industries they work in because I got a guy. I can tell you the companies, actually. I'm trying to get Tantalus Holdings on. Tantalus Holdings is trying to build the infrastructure and the tech that is going to be making EVs capable because a lot of people talk about how great EVs are, but too many people don't talk about that the utilities aren't set up for EVs right now. And Elon Musk and Tesla are trying to mitigate those issues. But the problem is Tesla's not going to solve that problem on their own. And this guy has actually been trying to get a hold of Elon Musk because their businesses coincide so well. And I love talking to him. Fascinating company. It's called Tantalus Holdings. Another one is called, what's the other one? Liquid Meta. It's a crypto company that completely removes the volatility of the crypto market. I think their stock's trading down, but the actual company itself doesn't have any volatility to crypto assets, but they cash flow and they're making it so they can onboard institutional investors. And they're trying to modernize how they cash flow out the crypto market to make it institutional friendly, something Kevin O'Leary talks about a lot. A lot of interesting guys. So I'm going to try and bring those people on the channel and see if we can't just have some broad view conversations. I mean, these guys are running multi-million-dollar businesses. It's always fun to get some insights. Kyle, will you ever, sorry, what are you saying here? Will you ever have a meet and greet one day for your fans? Hey, if you want to join the chat group, I did meet and greets at Christmas time. We were going to do one in Vegas, but I had to cancel it. Luckily, I did because everyone there got sick. Unfortunately, caught that pandemic, which is pretty brutal. Yeah, if you guys want, let me see if I can find this link real quick for anybody. I want to get you guys in chat groups because we have our few chat groups right now. But ideally, what I would like to do is get more people onboarded. If you want, just send me a message. And if you ever want to meet up and grab a coffee anytime, I'm usually down. Typically, if I'm just floating around, you live in the Toronto area. If you want otherwise, we do have like specific investing chat groups. I need to put a discount code for this because I know many of you use our chart already, but for $15, if you guys just want to have daily conversations with me, I share a lot of memes, news, things that I find interesting, talk about these dividend stocks. I just threw the link down there you guys can use. Maybe I can just make a quick discount code for it. So if you own our Chartmaster products already, you can just, buy this at a discounted rate. So you're not getting the same product listing. So with that product, you basically just get all of our financial charts and you get a lifetime access to talk to me in our chat groups. But let me just do this real quick for you guys. If you want to join that, do you own any split corps? No, I do not. I am looking at them though. They are a feasible option for sure. So let me just do this real quick here. Gift cards. Where do I discounts? Sorry here, guys. I'm just going to do this real quick. If you just want to come into that group, just use discount code. I'm going to do passive income, baby. All one word, passive income. I'll do a fixed amount. We'll do $15 off. Boom. If you already own the product, heck, if you want the product for free, there you go. Discount code done. Passive income. Why didn't that work? A code already exists. Damn it. The code already exists with that. So let's just go passive. Sorry, guys. I feel like I'm doing this on the fly and it's really stupid. I'm sorry. I don't want to be shoving this stuff down your throat. So use passive coupon code Passive, Passive. You can join my chat group and get all our charts for $15, one-time fee. Boom, done. All right, let's move on. Discount code alpha. Yeah, I wish. It's discount code passive. So there you go. You get 50% off, $15 off. Anyways, Justin Trudeau is the Prime Minister. Dave Ramsey's stupid. Yeah, anyways, I think let's not get into the political rhetoric. Anyways, you guys give me a huge list of stocks here. I definitely appreciate it. I'm not sure if you covered this, but you've taken a look into oil and gas companies during this cycle, like Suncor, Pembina, great companies. Suncor's particularly is one, track Smash 20. Yeah, so the problem I have with oil companies, this is why I like Enbridge a lot. I'd rather get those oil companies that are relatively diversified, similar to like Algonquin Power, where you kind of get exposure to the oil industry, but I don't want like direct exposure because it's far too cyclical. I've talked about this many times in the past. When oil's doing good and we're in these boom cycles, it's great. But the problem is typically, oil inevitably comes down in price and the stocks usually flatline. So we're kind of in a super cycle for commodities right now. And it's just, you got to get a little concerned because if you're buying them now, I would be more inclined to buy them for a swing trade if they're pure oil plays, because it's annoying buying the top of the markets. And typically when everybody and their grandmother's talking about it, it's a little bit more concerning rather than buying it when it dropped to those crazy lows. So I just be careful with oil. I like it though. I think it's great. This is going to be a time to print on oil stocks for sure. Enbridge, exactly. But anyways, folks, I'm not going to continue rambling. I really appreciate everyone coming out, offering some dividend insights. Stay cool, stay awesome, and I look forward to catching you all in the next one. Peace.